Hello everyone and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is November 19th, 2025, and we're taking a close look at the Nasdaq 100 ETF, ticker symbol QQQ. There's a lot of fear in the air, with headlines talking about slides, skids, and even crashes. We'll start by dissecting the news driving this sentiment, and then dive deep into the charts to see what the price action is telling us. First, let's talk about the macroeconomic environment. Multiple reports from sources like Barron's and Yahoo Finance indicate that futures for the Nasdaq, S&P 500, and Dow are all pointing to a lower open. This continues a trend of risk-off behavior we've seen developing over the past week. A major factor contributing to this nervousness is the upcoming earnings report from Nvidia, which is a huge component of the Nasdaq. Investors are clearly on edge, waiting to see if the AI giant can meet lofty expectations. Additionally, the market is still dealing with the fallout from the record-long government shutdown, which has caused significant delays in the release of major economic data, including labor reports. This lack of clarity makes investors hesitant to take on risk. We've seen headlines from the Economic Times and MSN describing recent market action as a crash or tumble, with the Nasdaq sinking over 2% in a recent session. This was noted as one of the worst one-day losses in over a year. The narrative is that high-valuation tech stocks are being dumped amid rising treasury yields and economic uncertainty. The Wall Street Journal also highlighted that the Nasdaq slide in November has already deepened to over 3.6%. This negative sentiment seems to be broad-based and is putting significant pressure on tech stocks specifically. Now let's see how this bearish news translates to the daily chart for QQQ. Looking at the bigger picture, QQQ has had a phenomenal run for most of 2025, recovering aggressively from a sharp drop in early April where it bottomed out near 402. The price climbed steadily for months, eventually putting in an all-time high around the 635 level in late October. This 635 area now stands as a massive psychological and technical resistance level. Since that peak, however, the story has changed dramatically, and this is where the news and the chart begin to align perfectly. We're in a clear pullback or the beginning of a correction. Let's zoom in on the action since October to see this reversal more clearly. As you can see, after hitting that peak near 635, the selling pressure began almost immediately. The month of November has been particularly brutal, with several large red candles indicating strong selling volume. On November 6th and 7th, we saw significant drops, followed by another sharp leg down on November 13th, where the price fell nearly 1.5%. The selling has continued this week, with yesterday, November 18th, closing down over 0.5%. The price is currently hovering around 596, which is well off its highs from just a few weeks ago. This price action confirms the risk-off sentiment we're reading about in the news. Switching to the 1-hour chart gives us a more granular view of this downtrend. What we can see here is a classic downtrend structure of lower highs and lower lows. After the drop on November 13th, the price attempted to rally but was rejected around the 612 to 613 level, which now acts as a short-term resistance. It then proceeded to make a new low yesterday, breaking below 600 with conviction. The price has been struggling to reclaim the 600 level, indicating that sellers are currently in firm control. Any attempt to bounce is being met with selling pressure. This shows that short-term momentum is firmly bearish. Now let's look at the 15-minute chart for the most recent price action from the last couple of sessions. Yesterday's session was defined by a large drop in the afternoon, taking QQQ from around 602 all the way down to the 591 level. There was a small bounce attempt into the close, but it lacked significant strength. Overnight, the price has been consolidating in a tight range, currently sitting just below 600. The key takeaway from this intraday view is the establishment of a support zone around 591 to 593. This is the immediate level that bulls need to defend. A break below this level on the open would likely trigger another wave of selling. Okay, let's switch back to the daily chart to recap and discuss what to look for going forward. The market is in a precarious position, heavily influenced by negative headlines and upcoming catalysts. Let's outline the key price levels you need to have on your radar. Immediate, critical support is the recent low around the 591 to 593 area. If we break and close below 591, the next logical area of support is the zone between 560 and 570, which corresponds to the highs from back in August and early September. That would represent a significant further drop from current levels. On the upside, the first major hurdle for bulls is to reclaim the 600 level. Beyond that, key resistance sits at the recent bounce attempt high around 612, and then the more significant resistance is up at the all-time high of 635. So, what are the potential scenarios? Given the current downward momentum and the fearful market sentiment, a bearish continuation seems the most probable outcome. I would place about a 70% probability on price testing and likely breaking the 591 support level in the coming days. This would be reinforced by a negative reaction to Nvidia's earnings or weak economic data. A break of 591 would open the door for a move down to the 570 support zone. A less likely bullish scenario, which I'd give a 30% chance, would require a strong positive catalyst. This could come from a blowout earnings report from Nvidia that eases market fears, or perhaps some surprisingly strong economic news. For this scenario to play out, we would need to see price not only hold the 591 support, but also break decisively back above 600 and then challenge the 612 resistance. The key things to watch are Nvidia's earnings report this Wednesday and any delayed economic data releases scheduled for this week. These events will be the primary drivers of the market's next major move. Be prepared for heightened volatility around these releases. And finally, a disclaimer. This video is for educational purposes only and should not be considered financial advice. You should always conduct your own research and consult with a financial professional before making any investment decisions.